Santelli standing by at the CME. Rick, the numbers, please.
Well, we're a little early for the numbers, but I will tell you that claims, we really want to pay attention to the continuing claims as they ever near 1.9 million. Last look that we had, 1,840,000 was on the higher side, and we've seen, 1, 2, 3, 4 above 1.8 million. This most likely will be 5 in a row. And on the spending and income side, of course, everybody's asking the same question, Joe. Where did that 5.2% GDP come from? Maybe it's the dual speeds with respect to some of the positives of stay-at-home work. So much savings. You go online, 6,000, 7,000 just in food. Well, somebody would say, of course, that's coming away from businesses that are losing that in the downtown and more urban areas. But maybe it's just different speeds. The loss side on one isn't reflective of the spending consumption side on the other. And now we're at 8:30 Eastern. I'm going to check out the wires as they spin by, and the numbers are starting to populate. Let's look at personal income and spending. Jobless claims hitting the wires first. 218,000 on initial jobless claims, spot on with what the analyst expected. 218. 1,927,000 for continuing claims. We just popped over the 1.9 million I was referencing. It hasn't happened since November of 2021 when we were at 1,964,000. So that is something to pay attention to. Let's watch those yields. Personal income up 0.2%, exactly as expected. If you look at the spending side, also up 0.2, exactly as expected. Real personal spending, accounting for inflation, deuces are wild, also up 0.2%, which is 1/10 better than we were looking for. Now, all three are less than the rear view mirror. Revisions haven't hit the wires yet. And this one, the middle one, particularly on the spending side, that's coming off of up 0.7. So we want to pay attention to any revisions that might come down the pipe. Now let's get into the real important numbers. Personal consumption expenditure, the deflator, month over month, expected to be up 1/10, is unchanged. Goose egg following up 0.4%. Moderation there. Now we go from month over month to year over year, expecting a number of 3.1 and comes in at 3%, comes in at 3%. And this one we need to reference history. 3% is a new cycle low on this, and the last time we were anywhere near that level would be March of 2021 when it was 2.7%. Okay, now let's back to month over month. This time, the core PCE month-over-month deflator expected to be up 0.2, up exactly 0.2. Now, the biggie, personal consumption expenditure, core deflator year over year, 3.5 expected, 3.5 delivered. In the rearview mirror, we had 3.7, which was the lowest going back to May of 2021. So we see that these numbers are moderating on some of the issues regarding personal consumption expenditures. That's most likely something the Fed will welcome. I'm a little surprised that yields haven't moved a little bit more aggressive to the downside, especially on the continuing claims number. But here we hover. We have two-year note yields basically unchanged. All the other yields are higher. Curve is getting less inverted. That is a positive in many ways. A more steepening curve will be bringing back more normalcy, and it will lower things like hedging costs for those, of course, that are looking towards Japan and what may be down the road in tightening and how that may affect currency and carry trades. We see that the pre-opening equities certainly don't seem to be very nervous about the jump in claims. They're holding on to very sizable gains and extending them as we are discussing the numbers. Joe, back to you.
I mean, that 5.2% GDP just seems to get further and further in the past. Is there anything in these numbers that explain why that was such a hot number, Rick?
No, I don't think really that there is. I'm looking at the spending numbers here, and they have moderated, but they're still not bad. I think the real issue here continues to be, Joe, let's say, that Look at government workers. Government workers, if you look at all the vacant real estate that they're not going to work and sitting in every day, that's a significantly larger amount of empty real estate than the private sector. But both of those stay-at-homes really want to fight to remain at home. They don't want to come back to the office. And I think embedded in that dynamic are many consumer positives that have contributed to much more consumption. And I think the other side of the ledger there is going to be what we see down the road a bit, and when we get a double punch, because people will be forced to go back to work, and some of those costs, well, they're going to seem much higher when you have to go back and spend higher money transporting and, of course, on the food and all the issues that you have to spend when you go back to work and leave home.